back to the pricing channel for small businesses. In our previous videos, we've talked a lot about using pricing strategies, tactics, tools, and actions to maximize business profitability. But we really haven't explained what we mean by business profitability. And so in this video, we're going to take a look at the subject of profitability and how to measure that so that we can determine the effectiveness of our pricing actions. So what do we mean by profitability? Well, that story starts with the classic profit and loss statement. And here's an example of a profit and loss statement that's properly formatted for financial management use. And what we'll do is go through and talk about the principal components of this statement, starting with revenues. The revenues always appear at the top of the profit and loss statement. On some statements they're called income, on others they're called sales, but it's all the same thing. It's the place where we capture all the revenues the business generated during a certain or particular period of time. In this case, April of 2020. Below the revenues, we see a category of expenses called cost of goods sold. And these expenses are literally what the title says. These are the expenses we incurred in either producing a product for sale or in offering a service for sale. And these expenses represent what it costs us to make the revenues that we made. And so when we subtract the cost of goods sold from the revenues, that gives us what we call gross profit. And gross profit is really the profits that have been made by the business for the business. And gross profit is the first measurement of profit that we come across in the profit and loss statement. Related to gross profit is another term called gross margin. And gross margin is the metric or the measurement of how efficiently we earned our gross profits. And so it's simply taking gross profit and dividing that figure by the revenues, which in the example of this particular statement would look like $38,472 divided by $84,803, which is equal to 0.45 or 45%. And so we would say in this particular period of time, this business has generated a 45% gross margin. And we'll talk about this a little more in a few minutes. Below the gross profit line comes another set of expenses that we call the overhead expenses. And basically, these are the expenses that we incur in order to put together the infrastructure needed to run our business. These expenses don't particularly refer to any given sale, but they're required in order that we can make sales at all. For example, in this particular profit and loss statement, we have a lease of $4,000 a month, we have utilities, we have insurance, and although these things can't be identified with any particular sale, they are absolutely necessary in order to be able to make the sales that we do make. And so this is why we call the overhead expenses the infrastructure of the business. And if we subtract the overhead expenses from the gross profit, we then get what's called net income or net operating income. And this is the second measure of profitability for our business. But net income is really what the business generates for the owner, whereas gross profit is what the business generates for the purpose of the business. Now let's say a little bit more about gross profit, or gross margin, Gross margin is related to the value which a business delivers to its customers. The more value that we deliver to our customers, the greater is our potential for higher pricing to monetize the value that we're delivering. And so higher prices then lead to greater revenues, which also lead to higher gross margin. So that's why we say there's a connection between gross margin and the value that we deliver to our customers. Now, higher gross margin also means a greater incremental gross profit per sales dollar that we receive. And so let's look at an example to illustrate this. So here we have the profit and loss statement that we saw at the beginning from April of 2020. Let's assume for a moment that we decide to increase our prices by 5% across the board. Now, assuming that our sales volume doesn't change, then this would lead to the following profit loss statement, say for May of 2020. And what you notice here is, because of the price increase, revenues have gone up by about $4,000, again assuming equal sales volume. Cost of goods sold has stayed the same, and so gross profit has gone up by $4,000 also. If we calculate the gross margins of these two cases, we see in the April statement that we have the 45% gross margin that we calculated before. But now for May, because of the price increase, we now are generating a 48% gross margin. And what this means on an incremental basis is that each sales dollar that we receive from a customer now yields us 48 cents of gross profit instead of the 45 cents of gross profit from the earlier profit and loss statement. And that is a lot of what we're going to talk about in future videos. What pricing moves can we make to improve gross margin and improve profitability? So let's put this all to work. In the next video, we're going to go back and talk about price and demand again, but this time from the perspective of using our knowledge of price and demand to improve our profitability. And so please hit that subscribe button so that you don't miss a single video. And I look forward to seeing you again.